plus 6.17%, in a single day. Now, in most markets, that's a big deal, right? It makes headlines. But in the silver market, a move this violent, it's not just a headline, it's a signal flare. It is literally the sound of a trap, one that was carefully set just the day before, snapping shut on the wrong people. And this whole thing, it tells a story that reveals a massive shift happening in global finances as we speak. Welcome to Bullion Signal. Our whole mission here is to decode market moves exactly like the one we just saw, to give you a clear, actionable perspective. If you want to stay ahead of these really critical shifts, go ahead and take a second to subscribe. You'll be joining a growing community of people who are trying to do the same thing. All right, let's get into the mechanics of what just happened. So to really get a handle on this, we're going to look at it from a few different angles. First, we'll set the stage with the big macro picture. Then, we're going to dive into the two main triggers, the paper squeeze and the physical reality. After that, we'll see how a bit of industrial panic is throwing fuel on the fire. And finally, we'll talk about what it all means for what comes next. Okay, first things first. It is absolutely crucial to understand that silver isn't moving in a vacuum here. A 6% surge like that, it's not really about silver. It's more like a fever, a symptom of a much larger condition. You see, the entire global financial system is, it's trembling. It's groaning under the weight of just unprecedented debt, stubborn inflation, and this desperate search by big money for real, tangible assets. Things you can't just print into oblivion. And, the first and clearest signal of this system-wide stress, it's gold. When you see gold smash through a threshold like $4,500 an ounce, you're not just watching a price move on a chart. What you're really witnessing is a global vote of no confidence in central banks and their currencies. Capital is literally fleeing from assets that just bleed value. And gold is the primary safe harbor. And silver, that's where that capital often goes next when it's looking for some real leverage.
So, the big question is, how does all that background stress translate into a 6% explosion in a single day? Well, it starts with our first pillar, the paper squeeze. This is where the real fireworks happened. You see, the silver market has this massive paper side, futures, derivatives, you name it, where people are placing bets on its future price. And what happened recently is that a very large, very crowded group of players made a huge bet that silver's price was about to go down. Boy, were they wrong.
Now, to really get this, we have to talk about something called a short squeeze. It's an incredibly powerful thing to watch. Basically, sellers bet that our price is going to drop. But what happens when the price goes up? Instead, they're forced to buy back the very thing they bet against just to stop the bleeding, to limit catastrophic losses. This forced buying creates even more demand, which, you guessed it, pushes the price even higher. It's this brutal, self-reinforcing spiral that just traps more and more short sellers. So here's exactly how the trap was sprung. The day before the big move, the price was deliberately pushed down 4% to $74. Now, this was not a random move. It was engineered, designed to trigger all the automatic sell orders from smaller investors, what the big guys call a hunt for liquidity. They essentially flushed out the weak hands, and in doing so, created this big pool of cheap silver for much larger players to scoop up right before the real move. And the result of this little two-day maneuver is just an incredibly powerful signal. Think about it. All of the selling from the day before was completely erased, and then some, by the massive buying today. In the world of charting, this is a classic sign of a violent shift in momentum. The bear trap, the one that was designed to catch the bulls, it ended up snapping shut on the very short sellers who built it. Let me ask you a question. And I'd love to hear your thoughts on this in the comments. Have you ever been shaken out of a position like that? You know the feeling. You see that sharp drop, you panic, you sell, And then you just have to watch in frustration as the market immediately reverses and rockets higher without you. It's an awful feeling, right? It's a really common experience, and it's exactly the dynamic that was engineered here, just on a huge institutional scale. But listen, that paper squeeze, that's only half the story. The second pillar here is arguably even more powerful, and that's the physical reality. This is where the paper promises have to meet cold, hard metal. And for months now, a massive disconnect has been growing, a gap between the price of silver on paper in New York and the price of actual physical silver being traded over in Shanghai. I mean, just look at these numbers from the day before the pop. The paper price in New York was $74 an ounce. At the exact same time, the physical price over in Shanghai was $86. That's a $12 per ounce difference. A spread that wide is it's completely unsustainable in a global market. It's a glaring neon sign of an arbitrage opportunity that the market simply cannot ignore for long. And arbitrage, it's really the market's great equalizer. The math here couldn't be simpler. You buy the physical metal where it's cheap, in New York, and you immediately sell it where it's expensive, in Shanghai. This creates a powerful physical drain of metal from the vaults in the West to meet that real, tangible demand in the East. And that forces the lower price, the one in New York, to rise, and rise violently, just to stop the outflow of metal. So here's the crucial takeaway. That 6% jump, it wasn't just about a paper short squeeze. It was the moment the New York paper market finally capitulated. It was forced to start closing that massive $12 gap because the physical market in the East is now dictating the true price. The physical reality, not the paper one, is finally in control.
Okay, this brings us to the third critical force that's really amplifying this whole move, and that's industrial panic. Now, for manufacturers, think solar panels, EVs, electronics, silver isn't some investment you can time. It is a critical, non-negotiable input for their production lines. So for them, seeing the price spike from $74 to $80 isn't a profit opportunity. It is a full-blown supply chain emergency.
And this is where we have to make a really important distinction between two types of buyers. An investor, they can always wait for a better price. A factory cannot. Imagine you're the purchasing manager who was waiting to buy at 74. You wake up and see the price ripping past $80 overnight. Well, your decision was just made for you. You have to buy, now, at any price, simply to keep the assembly lines from shutting down. That, my friends, is not investing. That is pure panic buying. And this kind of thing has a lasting effect. You see, the era where manufacturers could just count on cheap, stable silver prices, that's probably over. This industrial panic buying, it establishes a new, much higher baseline, a new floor price for the entire market. What that means is there's simply less room for the price to fall back down because you now have real, price-insensitive industrial demand fighting to secure supply in this new higher range. So let's just take a step back. We've got the paper squeeze and the physical arbitrage, and both of those are being amplified by industrial panic. But there is another factor at play here. It's a psychological element, and it has the potential to make these market moves even more extreme as we head into the next phase. This brings us to a really interesting psychological phenomenon known as a seller's strike. Just put yourself in the shoes of someone holding physical silver for a second. You see the price jump 6% in a single day. What's your incentive to sell today? Pretty low, right? You're going to hold on, assuming it'll be even higher tomorrow. And that's exactly what everyone does. Scrap dealers, refiners, even miners, they all start to hold back supply, waiting for a better price. And this creates an incredibly dangerous situation, something we call a liquidity vacuum. Think about it. At the exact same moment that short sellers and panicked industrial buyers are desperately scrambling to find metal to buy, the people who actually own it are pulling it off the market. You have exploding demand crashing into vanishing supply. The result? Insane volatility, where even tiny little orders can cause absolutely massive price swings. All right, let's do a quick recap of what we've gone over here in part one, because it's a lot. What we're seeing is basically a perfect storm. You've got a paper short squeeze that's forcing panicked buying. You've got strong physical demand from the east that's pulling the price higher. You have industrial panic raising the entire price floor. And to top it all off, a seller strike is literally removing supply from the market. That's four powerful forces, all pushing in the exact same direction. So I'd really like to hear your take on all this. When you look at these four factors and you consider the bigger macro picture we talked about, what do you think is the number one driver behind this incredible move we're seeing in precious metals? Is it the gains on the paper market? Is it the raw physical demand? Or is it something else entirely? Drop your analysis down in the comments below. I'm curious to see what you think. And believe it or not, this is really just the setup. In part two of this deep dive, we're going to go even deeper. We're going to talk about the hierarchy of money and exactly where silver fits into that pyramid. We'll break down the all-important gold to silver ratio and what it's telling us about silver's true potential. We'll even provide a scenario framework to help you think about navigating this volatility. And we'll uncover the final hidden signal in this market. It's going to be good. Seriously, you are not going to want to miss how this all comes together. The easiest way to make sure you see part two is to just click that subscribe button and turn on your notifications. We'd love for you to join the Bullion Signal community as we continue to track these historic market shifts together. And finally, just our standard professional disclaimer. Please remember, this analysis is for informational and educational purposes only. It should not be taken as financial advice. The markets we talk about here involve a significant amount of risk, so please always do your own research and consult with a qualified professional before making any investment decisions. Stay safe out there.